Hi everyone, Nick here. Welcome back. Today we'll discuss an advanced investment strategy that may reshape the way you think about investing. This is using leverage to add time diversification to your portfolio. A couple Yale professors wrote a book on this topic called Lifecycle Investing, where they argue this is a safe way to boost the performance of your portfolio and retire earlier. Is this too good to be true? Well, let's dig in and find out. We'll start with an overview of the strategy, the theoretical foundation, and some of the biggest risks. Most people's portfolios look like this one over time. Their portfolio grows as they age, and then when they retire, they start drawing down the portfolio. The problem is that when you're young, you have the most ability to take risk, but your portfolio is small. When you're older, you have less ability to take risk, your portfolio is the largest. This exposes you to a sequence of returns risk. If the last years approaching retirement have poor returns, it could really hurt your retirement income. This chart is also missing very important assets, which are your future earnings and Social Security. The authors argue that you should discount these to present value and count them like bonds in your portfolio. This would mean that even with a 100% stock allocation in your investment accounts, your allocation to stocks is quite low compared to your future earnings and Social Security. This is why the strategy suggests borrowing to invest more in stocks when you're young is possibly a sensible thing to do. It's diversifying your exposure to stocks over time. Investing with leverage comes with a lot of risk, and the authors recommend limiting leverage to about 2-to-1. Here's a chart showing one of their strategies against a more traditional birthday rule strategy. You can see that the leverage strategy starts at 200% stocks when young, then adjusts to below 50% near retirement. They backtested several of their strategies against more traditional glide path strategies. Their analysis showed that during the historical period studied, their approach would have resulted in higher returns with comparable risk. Even in the worst case scenarios, their life cycle portfolios would have been better. Since the leverage is mostly during younger years with a lot of future earnings ahead, there would be time to recover in the worst case where you lose it all early. There are no guarantees this will hold into the future, but it's pretty compelling from a theoretical perspective. I really enjoyed listening to this book on Audible. I'll put a link in the description below. Now we'll look at some of the theory behind this strategy. The foundation is modern portfolio theory. This is explained best with an efficient frontier graph. The y-axis has the return, and the x-axis has the standard deviation, which is a proxy for risk. The ideal would be to have the highest return with the lowest deviation. We look at portfolios containing the S&P 500 and 10-year treasuries from 1970 to 2020. First is the 100% treasury portfolio. It had about a 3% return and a 9.5% standard deviation. Next is the 100% S&P 500, which had a much higher return, around 6.5%, but with a standard deviation approaching 17%. Neither of these are at the top left of this graph where we would like them to be. The remarkable aspect of modern portfolio theory is what happens when we combine these two assets in a portfolio. Now, as you move along this line from 100% bonds to 100% stocks, you're reducing the amount of bonds and adding stocks. The fourth point along the line represents 40% S&P 500 and 60% 10-year treasuries. What we notice here is that this portfolio has less risk than the 100% bond portfolio, but it yielded a higher return, about a 60% higher return. The reason for this is that the prices of stocks and bonds often move in different directions. Combine this with rebalancing, and you get what many call the only free lunch in investing. around this point at 40% S&P and 60% bonds would have been roughly the most efficient portfolio you could have on a risk-adjusted basis with these two asset classes. This is called the tangency portfolio. For each unit of risk, it delivered the highest return. These are the basics of modern portfolio theory. The same concept applies to adding additional asset classes like international stocks to the portfolio. I made another video that goes into more details, which I'll link up here and below. While the 40% S&P and 60% bond portfolio provided the best risk-adjusted return, many investors want a higher return and they can bear more risk. Such investors might try to pick the best stocks, pick up funds like ARK, and so on. They take extra risk by removing diversification. This is called idiosyncratic risk. Historical data shows this type of risk is generally not rewarded. This is one reason why most investors, including professionals, will underperform the market over the long term. They try to get a return above the efficient frontier line, but fail and end up towards the bottom right. This means that most investors would be best off with the market portfolio. Some argue that using leverage is best done with the tangency portfolio. In theory, you can draw a line like this, the tangent of the tangency portfolio. Applying leverage with this portfolio could allow you to get exposure along this line and be more efficient than the 100% stock portfolio. Due to fees and interest, you probably won't get right on this line. Remember, these are historical returns, and the future may be different. We can only use this historical data to make educated guesses about the future. Leveraging the tangency portfolio is a little different than lifecycle investing, where most investors would be starting off with 200% in stocks, but they are very similar concepts. This sounds great, but is it too good to be true? Well, the theory and math are sound, but there are several challenges. First, we have no way of knowing what the tangency portfolio will be in the future. We can use past data to guess. However, if the shape of this efficient frontier line is comparable in the future, we could tolerate a good amount of error where the tangent may still be more efficient than adding stock exposure. Second, using leverage costs money. You have to pay interest and fees to borrow money. Depending on how you do it, these costs could eat away your expected return. This strategy assumes the stock market returns will be greater than the cost of leverage, which may not always be true. Third, using leverage can add another type of risk. Certain types of loans, like margin loans, are risky since you can get hit with a margin call in a downturn. Fourth, this strategy can be a bit complex to implement. I'm not going to get into all of the details of how you could implement such a portfolio in this video, but the most cost-effective way is typically using options or futures contracts. These are much more complicated than simple index funds. It can get even more complicated with different investment accounts and tax treatment of futures and options. Fifth, it adds a degree of active management to your portfolio. If you end up using options or futures, they require much more active involvement on your part. This could tempt you to try market timing, which is something most people fail at doing. And last, most people don't need this extra risk or hassle. Most people become wealthy by earning and saving more money, and diligently sticking to this over the long term. Adding all of these extra risks just to reach the inevitable finish line a little faster could have more potential downside than upside. The Bogleheads forum has a really long thread from a user named Market Timer. He was a PhD economics student that implemented the Lifecycle strategy in 2008. As the market started to crash, he deviated from his original strategy. Instead of keeping constant leverage and rebalancing, he increased his leverage as the market dropped. He kept getting hit with margin calls. He even borrowed money on credit cards to make some of these margin calls. In the end, he didn't just lose everything. He had over $200,000 of debt in what appeared to be his mid-20s. He faced probably the worst case scenario when starting with the strategy and made a huge behavioral mistake. I'll put a link to this thread below. It's a cautionary tale of what can happen when implementation doesn't meet theory. Let this serve as a warning to be careful if you are considering about doing this yourself. You need to invest a lot of time to research this, understand all the risks, and have a plan you can stick to. Be real with yourself. If you're going to have nerves of steel and not let your emotions get to you, it might work out for you. Most people have enough leverage when they're young between a mortgage and student debt, and most cannot stomach the risk. One alternative that could add risk with potential positive expected return is factor investing. This could actually be combined with leverage. Factor investing is basically adding extra exposure to certain types of risk to your portfolio, like small value or momentum factors. Unlike the idiosyncratic risks we talked about earlier, research suggests that these risks were rewarded in the past. Whether they will be in the future is another question. I made another video on factor investing, which I'll link below. I think leveraging the tangency portfolio is an interesting idea. If I were to implement this strategy, it would be with maybe 5 to 10% of my portfolio as a hobby portfolio. Many people use 5% to gamble on individual stocks or options. I would consider leveraging the tangency portfolio instead. I want to hear from all of you in the comments below. What do you think about life cycle investing or investing with leverage? Does it make sense? Do you think you have the emotions of a robot and can execute this strategy well? Or do you think it's too complicated and risky? I'm really interested to hear your thoughts. If you want, I could make another video with some more details on how such a portfolio could be implemented, how to discount your future earnings or Social Security, and more. Thanks for watching, everyone. Don't forget to smash the like button if you enjoyed the video. Later.